Welcome back. It's time to update on my ISA portfolio. How has it performed? What's impacted the results? And what I'm going to be doing over the next period and during this very jittery market we're all facing at the moment. So you could certainly describe January and February as being interesting months. We've seen significant jitters across the economic landscape in the US, here in the UK and across the globe. So in this video, I'll break down what this means for my ISA investments and potentially yours, and what adjustments I'm considering making as we go forward. So the questions I'm asking are we heading for continued growth, or are those storm clouds that I mentioned last time getting closer? So let's dive in and find out. But before I dig into the ISA performance, let's understand those key factors that have been shaping the markets recently. Let's start in the US. Well, the US feels like we're going through a slow motion car crash at the moment, but it's showing surprising resilience. The recent data is painting a picture of a slowing economy. In February, growth in the US activity slowed down and the service sector actually contracted for the first time in over 2 years. The S&P Global US Composite PMI index hit a 17-month low. That signals, according to the PMI, that the economy is nearing stagnation. And if you're interested in knowing a bit more about the PMI index and the other macro indicators I tend to follow, you can see a little bit more information about that in the link above. And it's not just slow growth in the US that's causing the market's concern. Inflation is back in the spotlight again. The annual inflation rate in the US rose more than expected to 3% in January. That was fueled by rising energy costs, pardon the pun. The consumer price index and core inflation both surprised the markets as they went up. So not surprisingly, consumer sentiment has taken a bit of a hit, dropping to a 15-month low as people worry about the rising prices of goods. Consumers are now expecting inflation to average 3.5% annually over the next 5 to 10 years. That's the highest expectation in nearly 3 decades. So how did the US stock markets react? Well, not too well. US stock markets responded negatively to this economic data and the inflation news. And on Friday, February the 21st, both the S&P 500 and Dow Jones Industrial Average had their worst day since December, plumping by 1.7%. The tech-heavy Nasdaq also took a hit, dropping a whopping 2.2%. Now we know slumps and dips happen pretty regularly in the markets. They're a feature and not a bug. So if you need further tactics and strategies to deal with those dips, then I've created a video above that talks through the mechanisms and the approach you might want to adopt when you see those dips occurring. So what were analysts pointing out during these weaker than expected economic reports and the slump in consumer confidence? They are key drivers to market downturns, in their opinion. It's clear that investors are starting to factor in the possibility of slower growth and persistent inflation in the US, in their opinion. As well as this, the uncertainty that exists regarding tariffs and the new administration's policies and the impact of large-scale job losses across the public sector through the actions of DOGE are causing real jitters across the markets in the US and globally. And back across to this side of the pond, the UK is facing similar macro challenges. Business activity in the UK is essentially stalled for the last 4 months. The S&P Global UK PMI Composite Output Index is barely above 50, which marks an indication of whether there is growth or not, and at the moment it's almost zero growth. Whilst the service sector is showing slight growth, manufacturing is contracting at its fastest pace in over a year. Adding to these concerns, the UK firms are seeing their costs rise at the fastest rate since May 2023. Input costs for manufacturers are climbing at the quickest rate for over 2 years. This is likely to put even more pressure on prices and could lead to further inflation increases beyond the recent upticks that we've already seen. But interestingly, on the good side, we did see a surge in UK sales growth in January, with volumes jumping 1.7%. However, despite this positive data, consumer confidence in the UK remains fragile. We did see, sadly, that the CPI, the consumer price inflation figures, often quoted as a general inflation, again hits 3%, jumping from 2.5% in December. Now, this again was greater and higher than the expectations in the market. They expected it to go to 2.8%. Now, this is largely blamed on transportation, airfares, food, non-alcoholic beverages, and also the addition of VAT to private schooling. So how has this all impacted the stock market in the UK? The UK FTSE 100 has been remarkably resilient during this period, with a strong year-to-date growth. Now zooming out to the global level, we're seeing a quite divergent picture across the different countries and different economic performances. While the US and UK are showing signs of slowdown, Japan's economy seems to be picking up quite a pace. Europe, on the other hand, continues to experience near stalled growth, but that's not reflected in the market. As mentioned earlier, European stock markets actually outperformed the US year to date. The MSCI Europe, excluding the UK, rose by over 7%, boosted by strong corporate earnings, particularly in the financial and consumer sectors. So at the time of recording this video, despite all this uncertainty, global stock markets have been trending upwards in early 2025. This is partly due to the ongoing expectations of interest rates from central banks reducing and hopes of continued economic earnings growth, even with inflation and tariff concerns lingering. So if I had to put my finger on what the analysts are saying mostly and around their concerns, they continue to highlight several factors impacting the markets. One key concern is the political uncertainty and trade policies. And if you're a global investor, the policy uncertainty is also a major factor in the US. Some analysts suggesting that worries among consumers and businesses about Donald Trump's policies may be hitting the US economy. Well, I would move that from maybe hitting to absolutely are hitting the US economy. And closer to home, I think that most investors want clarity. So reports suggesting that ISAs will be capped or the rules around them changed, it only creates a more uncertain environment.
How dare they?
So what's the key takeaway from all this? Well, the economic data from the last couple of months at least point to potential shift away from the strong growth that we've seen previously and over the last couple of years. The slowdown in the US service sector, persistent inflation, and political uncertainties are creating considerable headwinds for stock markets. And the impact of this as we go forward will very much depend on things like the inflation trends, how they evolve, how central banks respond with interest rate policy, and how the global political landscape and trade landscape unfolds over time. It's a time of increasing uncertainty in the market, so the key is to stay informed, stay calm, and carry on.
Stay calm, everybody.
So let's turn our eye to my portfolio update. I'm pleased to report it continues to grow. My portfolio currently is valued at just under £279,000, an increase of approximately £1,000 in the last month. Now, considering the volatility in the market, I'm really happy to see any growth during the last month. But even if it had been negative, these investments are for the long haul. So let's examine the performance of my key holdings, starting with the provider where I hold the majority of my ISA portfolio, Best Invest. Starting with the Fidelity World Index P investment, it continues to show strong performance overall. It mirrors the MSCI World Index and has delivered a very impressive 24% return over this year and a quite remarkable 88% over the last 5 years. All this while maintaining a low ongoing charge of 0.12%. And the real question here is, can this exceptional performance continue? So while I know the long-term outlook for global equities remains positive, there are valid concerns at the moment about valuation levels in the US markets and potential market corrections. And certainly, market analysts are increasingly suggesting more moderate returns are likely in the near term. And so to mitigate the potential downside risk, I'm still maintaining a higher cash allocation than my usual target. Instead of my typical 3 years of living expenses in cash, I'm holding close to 4.5 years of cash assets, primarily in money market funds. As mentioned previously, this cash buffer acts as an insurance against market downturns and also provides dry powder to deploy if opportunities do arise. If you'd like to know a bit more about my investment approach, asset allocation strategy, etc., you can see a video above which talks to this. So the returns from the money market fund held within my Best Invest ISA are coming out at around 5% over the last year. And this is linked closer to the SONIA rate, not the stock market directly. So let's move on to my ISA sitting with Trading212. My investments are within the Vanguard FTSE Developed World ETF and the Vanguard FTSE Emerging Markets ETF. Since my initial investment of just under £20,000 in April 2024, the portfolio has increased to just over £22,700, generating a return of approximately £2,700. That represents an increase of 13% since last April. In respect of my partner and my daughter, our set and forget Vanguard ISAs are also performing well. They're invested in the Vanguard FTSE Global All Cap and they're showing healthy growth over time. My daughter's junior ISA, with a total contribution of £18,000, £9,000 in early 2024 and £9,000 just after the tax year, is now valued at £20,495. That represents an increase of £2,495. My partner's ISA, with a total invested of £38,000, £18,000 pre-tax year and £20,000 within this tax year, has grown to £43,843, an increase of £5,843. Collectively, the total value of the family ISAs, not including the money market fund, is now approaching around £350,000. So what's next? Well, I continue to remain comfortable with the current investment strategy and our asset allocation. These investments are for the long haul, and so volatility in the short term is not really that concerning. That said, I'll continue to monitor the market developments closely. I'm going to perform monthly portfolio reviews and rebalance my Trading212 portfolio as necessary. And I've created a video around rebalancing. You can see that above if you're interested in how you can do that on an ongoing basis. As mentioned, my increased cash holdings provide a greater buffer against potential market volatility, and they offer flexibility to capitalize on investment opportunities should the market conditions change. And as we approach the new tax year, my focus will shift towards BED and ISA and BED and pension strategies. This will enable us as a family to transfer a significant portion of assets, potentially exceeding £100,000 across the family, from my general investment accounts into our tax-sheltered ISAs and pensions. I'll talk a bit more about that closer to the end of the tax year when I do my next ISA update. Looking ahead to the future contributions I want to make into my ISA, my long-term investment horizon remains unchanged. Living expenses are currently covered by other income sources, so I anticipate to continue to maximize ISA contributions for at least the next 12 years. So assuming no changes to ISA allowances, this would result in an additional £480,000 invested across my ISA and my partner's ISA, £20,000 per year each for the next 12 years, and additional contributions going into my daughter's ISA of £9,000 per year for the next 8 years. So if we project this forward using a compound interest calculator with a nominal return of 7.5%, our combined ISA pot for my partner and I could potentially reach about £1.5 million. And my daughter's junior ISA will also grow considerably to over £100,000. Of course, these projections do not account for inflation, and they're assuming a 7.5% return at around average of what we've seen, but clearly it's not guaranteed. Transferring assets from general investment accounts to ISAs and pensions remains a really effective way to minimize future tax liabilities. While selling the assets, of course, triggers capital gains tax, the long-term benefit of tax-free growth within ISAs and tax-efficient withdrawals from pensions significantly outweigh the initial capital gains tax implications. So I hope this portfolio update has been insightful, useful, helpful. I'm committed to sharing my investment journey with you transparently, including both my successes and the adjustments I'm making. If you've got any thoughts or see things differently, then it'd be great to hear your views in the comments. And if you found this content valuable, please consider liking the video and subscribing. Thank you for watching, and see you in the next video.